Welcome back to Smart Money. We're here talking to Anish Tawakley, the Deputy CIO-Equity and Head of Research at ICICI Prudential Mutual Fund, about innovation in investing and what different sectors are going through in terms of innovation and how you can use this knowledge to make your investment decisions as well. Anish, before the break, we were talking about several sectors, right? I want to focus on NBFCs because there's a lot happening here and it's sometimes very hard to keep up because the competition is, there is competition from NBFC players to the banks. Banks are eating a lot of the market share. There are these new age tech companies coming through as well, fintech companies. So tell us, what is the radical innovation that's taking place in NBFCs?
See, what is driving that innovation, and I'm not saying it will be successful, in fact, I'm fairly skeptical about how successful it will be, is that you've got much more data about individual customers to help you make hopefully smarter decisions, right? And what we are seeing is a lot of financial institutions using that data to arrive at lending decisions. But I think here is one place where we at least are cautious about its ultimate outcome, because when you're lending, you have to judge both the ability to pay and the willingness to pay. And you have to have mechanisms, collection mechanisms, to collect money if the willingness to pay is missing on the consumer's behalf, right? So a lot of the data that we get is about the ability to pay, right? Willingness to pay will be tested when people choose to act difficult. And my concern right now on the NBFC space is a lot of NBFCs have not built in the collection costs that will come up when there is stress in lending, right?
Okay.
So lending always looks good while you're growing very fast.
And while the economy is growing.
While the economy is growing. But it's when the collection is required, right, that particularly in unsecured lending, the jury is still out. Right?
Okay.
So yes, there is innovation, but some of it may not prove to live up to the hype that is being
So for someone who's perhaps looking to invest based on innovation, you would suggest otherwise, that to be cautious in the NBFC space?
So you'll have to be very selective if you want to invest in NBFCs. I think, and that's one of the things that happens, right? There's a genuine innovation. It creates too much excitement initially, attracts too much capital, you have a period of churn, and then eventually a more stable structure emerges, right? So my point here is not that there's all NBFCs will not do well or anything like that, but to say that one has to be very careful. This is a bit like retailing, right? When you thought retailing is all about stores, I said, right? And it's not all about stores. Similarly, NBFCs are not all about disbursements, right? We haven't really tested the collection aspect of these NBFCs yet. So some skepticism is justified.
Any other areas where there's massive innovation happening, which is perhaps something investors should know?
No, actually, I want to step away from this notion of massive innovation in a particular sector, right? I think innovation is happening across sectors. Leave aside a few, right? Like commodities where there's very little room for innovation. A commodity company, if it has a low-cost mine or a low-cost oil source, can do well even without innovating, right? But in other businesses, almost as a rule, right, if you look at companies that would be gaining market share, they would be innovators, right? Whether it's financial services, whether it's retailing, whether it's consumer goods. If you keep making the same fan, same mixie, whatever, you're not going to win, right? So in almost every sector, right, you can see that innovation is happening.
Okay. So, you have a fund, there's an NFO, the ICICI Prudential Innovation Fund. So tell us a little bit about that. I want to understand more about what kind of companies will you be investing in? What is the time frame? Because, these kind of thematic funds, the concern is that, there's a lot of disruption happening. So what happens then? I mean, is it like a 12-month time frame, 18-month time frame where you revisit then? And what kind of returns can one expect if they invest in a fund like this?
The last question is easiest to answer because I'm not going to answer it. But more seriously, look, as I said, right, like 2 years back or even a year back, we thought all the opportunities are in the value space. By value space, in simple terms, it means companies that are struggling but will recover, right? And growth was being overvalued. Now we think the opportunities are more evenly balanced because the growth companies have corrected a lot. Expectations have become more realistic. Now coming to how you think about returns. See, typically when you're buying innovative companies, you would be paying a premium, right? Now, and then what I'm not in agreement with is this notion that, hey, these companies will do well 5 years later right?
Actually, but you don't generally pay a premium always, right? I mean, just to give you an example, correct me if I'm wrong, say a Tata Motors, right? They are innovating in a big way. They're doing EVs. They have, they're doing very well over there. But the stock is still trading
I can't talk about specific stocks.
Discount to its, historic valuation. This is just an example.
Yeah.
But I'm saying it's not, you don't always end up paying a premium.
So there are some exceptions, and I'm sure there are some exceptions, and these exceptions, without going into the specifics of a company, could be that a company, innovative company, has some balance sheet issues, etc. Or while it's innovating, the cycle is very negative, the industry cycle is very negative. So those will always be there, but in general, you'll find that you're either buying struggling companies or you're buying the winners, right? When you're buying the winners, you will be paying a premium, right? In general, one should go in with that mindset. But my logic, the way we think about it is that when you're paying a premium, you have to be more demanding about how they meet expectations, right? So it's not about sitting around and saying, oh, 5 years later, this company will do well. It's about saying, look, what is this company committing to deliver, and is it delivering quarter after quarter after quarter? If it's repeatedly disappointing, you have to revisit your thesis.
Okay. Just to summarize then, before we let you go and before we end the show, any final thoughts on what the big innovation could be, perhaps? What the big disruptors could be, say, in the next 1 year?
I think certainly there will be disruption in the energy space. There will be disruption in the transportation space. That is for sure. But there will also be disruption, not disruptions, but huge changes, particularly when you look back over 10 years. That take place across a broad set of industries. And some companies will do better at it than others.
Okay, on that note, we will wrap up with this discussion. Thanks a lot, Anish, for joining us here in the studio. And thank you to our viewers for watching. Keep writing to us. We love receiving feedback from you. Have a great weekend.